Hello, everybody. I'm Jeppe Kirk Bonde, one of the most copied investors on eToro. Welcome to my quarterly investor update for 2025 Q4. If you want to use this presentation for anything, please go ahead and read the disclaimer at the bottom here very carefully. So in this presentation, I'm going to go through my background, my investment strategy, what I have in the portfolio, and finally go through the many questions that I've received in advance. So firstly, one of the reasons I'm one of the most copied on eToro is that since I started investing in 2013, I've really beaten all the benchmarks and all the other top equity investors you can fairly compare with, and with a better return to volatility ratio. Since 2013, I've had an average annual return on investment of 25% per year. Now, my dad, he was a politician, leader of a political party in the European Parliament. And my mom, she was the CEO of a political newspaper. And I thought I was going to be a politician as well. Then I started studying international business and politics in Denmark. And I changed my master's to finance. And then I started work as a management consultant and advising some of the largest companies in the world, including tech companies, aerospace and defense, and banking. And then as I was doing that, I was making more money than I was spending. And so I wanted to invest my money. Then I compared all the different banks and brokers in terms of, how good is their website, how good is their app, what instruments are available to trade, what are the fees like, how secure is the platform, how is it developing over time. And I weighted all those factors for how important they were to me, then multiplied that up and ranked all the companies, and then eToro came out as number one. And so I started investing on eToro. And then that went very well. And because it went very well, people started copying me. So I got one copy, 10 copiers, 100, 10,000 copiers. And then in 2018, I quit management consulting to focus only on managing my investment portfolio on eToro and hired some people to help me do it. And then 1 year later, I was the most copied on the platform. And since then, I've been either number one or number two. And today, more than 27,000 people copy my portfolio with more than 160 million US dollars. Now, I don't do everything on my own. I rely on great suppliers that provide data and provide access to the best IT tools and a great network, especially of friends and family. If I invest in something, I must either myself be an expert or know someone who is. Otherwise, I can't get the important insights quickly enough. And finally, I'll highlight my three favorite experts, which are my three brothers. One of them, he did his degree in computer science and works for Control AI. And he's currently in Washington, D.C., meeting with the members of Congress and the Senate around AI regulation. One of my brothers, he's an economist with the Danish Ministry of Finance, doing the largest economics models we have in Denmark. And the last one, he's the CEO of a large marketing and advertising company. And so if I have any questions or concerns in those areas, then they are my go-to guys. My investment strategy is based on some principles that have been there all along. I focus on macroeconomics, evaluating what kind of growth rates different pockets of the global capital markets can have over time. Then I focus on mega trends, identifying trends that can grow by more than 10% for more than 10 years. And I focus on fundamentals, analyzing companies very carefully in great detail, understanding their products and services, their strategic options in the future, their competitive landscape, what are their suppliers like and their supplier, what it's like to be a customer there, what's it like to be an employee there, what's the management team like, what are their financial statements like, what have they been like through history, and so forth. All of that in order to do a discounted cash flow analysis, evaluating how much money the company can make in each year in the future in different scenarios. And then based off of that, what should that company really be worth? And then I like to invest in companies that I evaluate are worth a lot more than they cost in terms of price. There's a great quote by Warren Buffett who said that price is what you pay, value is what you get. And I really subscribe to that view. Then I focus on the long term. And that's often the one that's the most difficult to understand because the long term is made out of many short term. So shouldn't you just focus on the short term and then the long term will take care of itself? The reality is that if you want to run an investment portfolio or your life or a business in the best way, you're best off by focusing only on the things that will really matter 10 years in the future. The people that focus on the short term in terms of investments, they perform much worse in the long term, but they also perform worse in the short term. So it's sort of that doesn't really win for you. There's a great quote by Benjamin Graham, who was the author of the book The Intelligent Investor and sort of the mentor of Warren Buffett. He wrote that in the short term, the market is a voting machine. In the long term, a weighing machine. And I have the patience to wait around for the weighing. If a company one day becomes very big and profitable, then it will also have a price at that time. And I'm happy to wait around for that to happen. Then I focus on risk management, diversifying carefully across different industries, geographies, and business models. Hedging, that means taking different risks that, when put together, disappear. One example of that is that I have many companies in the portfolio that need a lot of energy. And if the energy prices were to increase a lot, they would lose money from that. But then I have other companies that produce energy and they would conversely gain. So then that offsets the energy price risk. And you can do that in many different ways to reduce the risk of a portfolio. Then I stress test the portfolio, crafting different scenarios for the future and evaluating how my portfolio could perform in that scenario, how different variants of it could perform in such scenarios, and then making decisions to change the portfolio to ensure I'll be okay in many different potential negative scenarios in the future and make a lot of money in good ones. Then I finally focus on keeping the fees low. I pay the same fees that copiers pay. So when I keep my fees low, copiers keep their fees low, and keeping the fees low is a great way to get a bit more profitability out of one's portfolio. And I don't use any leverage. I don't do any short selling. I don't do any day trading or anything like that. And yeah, that's I think the right way to do it. Then there are some areas in which I see great opportunities. I like companies that have organic growth, that are selling more products, increasing the price by more than the prevailing inflation rates. But that does not include companies that are just growing through acquisitions. So sometimes you have a company and, in their earnings call, they say like, oh, we grew revenue by 4% last year. And like, right, yeah, that's only because you acquired another company. Your core revenue actually shrank. So what you've accomplished is not that impressive. And then I like companies that are resilient, that have sustainable competitive advantages or a clear route for how to get them, that have a strong balance sheet, and that can protect my wider portfolio if certain negative things were to happen. Then I like companies that are truly profitable or have a clear path to get to true profitability, and especially if they can reinvest their profits into growing their own business. Then I like it even more. Then I like companies that have a new strategy because sometimes you can pay the price of the old strategy but get the value of the new strategy. It has, of course, to be a good strategy, and it's not enough that a company announces that now they have a good new strategy. I have to also see, real actions that prove to me that this is actually happening. Um, when yeah, you can change the name of the company, sell off a part of the company, buy another company. There are many things a company can do to show they're serious about a strategy. Then I like companies that have great products and services because the best product often wins in the long term. Um, if you're a smart shopper who can understand like why this product is better than that one, why it's worth paying more for this and not for this, why these features are important and these ones are not, why people will love this product once these things are fixed, but they won't love that product, then that's one piece of the puzzle you've fitted in. And if you don't understand products and services, then you cannot understand the companies behind them, and then that's just a different. Yeah, that makes it tough to be a great investor, I think. A classic example of failing at that was when Steve Ballmer, the former CEO of Microsoft, he held the first iPhone in his hand, and he, said, "Oh, it doesn't have a keyboard. Business customers won't use it. It's way too expensive." And he was, of course, proven wrong by the massive success of the iPhone. But that was a classic example of sitting with the blockbuster product in your hand and just not being able to see that this is the blockbuster product. Many people in recent years did the same mistake with Tesla, are now doing it with Nvidia and Palantir, and will probably do it with other companies in the future where they just cannot see that this is a good product or service. Um, then I like companies that are mission driven, not just because I sometimes believe in the mission, but because it can also be a great way to attract and motivate and retain the best people without necessarily overpaying them. There are some companies that even if they offer a higher salary, they just cannot attract the talent that they need. And there are other companies that are just pure magnets for talent, the smartest, most hardworking people. They want to go work there, and those companies just have a massive advantage in the long term. It might not show itself in next quarter's earnings, but a few years down the line, it definitely shows up. Then my portfolio is mostly invested into stocks. And historically, stocks has been the best category to invest in. Property has been good as well. Bonds have been okay. I think currently they're not as good with quite a high inflation compared to the interest rates. Commodities have historically done next to nothing. If you had a gold bar during the Roman Empire, you would have kept that gold bar, and today you would just have a gold bar. In recent decades, it's done better, but commodities overall over the long term has not really fared greatly. Collectibles is very popular for many people because people love these. So if you'd invested in Birkin bags or Rolex watches or Pokemon cards at the right time, that would have been great. But if you look at the asset class more broadly, including theft and cost of storage and many other factors, and stamp collections going down to zero and so forth, then you end up with it not actually being a very attractive category. And if you finally look at currencies, these have historically been terrible. They are currently terrible, and I think they will continue to be terrible. So whenever I have a lot of cash, I like to get it transitioned to the left in this chart and ideally invested into some stocks. Then all of these broad asset categories are all more than 250 years old. And I think they are enduring good categories. You can consider maybe cryptocurrency as a new category, but I think it's more appropriate to sort of think of each cryptocurrency as fitting more into one of these other categories. Some of them are more like currencies, some of them are more like tech companies, some of them are more like commodities. Then there are some factors that drive big global economic growth in the long term. I like to separate these out into the physical, the social, and the technological realm. In the physical realm, it's very important how many trees are in different countries, how much oil is in the ground, how much metals can be extracted there, and so forth. I also focus on life, animals, but mostly humans, the you know, how the demographics changing in different places over time. The companies that have the right product for the right demographics in the right places have an advantage over time. Then the realm in which the most value can be destroyed the quickest is the social realm. If you have a deed to a property, a stock, a bond, a US dollar bill, then these are just numbers on, these are pieces of paper, numbers on screens, words in people's heads. They only have value because we believe that others believe they have value. And if we stop believing that others will believe that these will have value, then that value will disappear very quickly. And believing these ones and thus giving them value can help us cooperate with one another, which is really beneficial. But you can ask yourself, why does anything really have value? It's very obvious to people that a house has value. It's made out of brick and mortar and concrete. It's very tangible. But ultimately, if nobody wanted to live in a house and nobody wanted to look at a house, then houses would not have any value. And what we as societies value can change over time. And if something's changing at a high rate and it's spreading from one society to the other, then that can really yeah, drive a lot of change in the long term, and that can be the basis for great investments. Then finally, there's the realm of technology, all the way from the deepest pits of the R&D labs to the final tweaks people are making to the way they're using products in the home. There's growth happening. The most important are the big technological foundational revolutions, going from through the agricultural revolution for humanity to the industrial revolution, then the internal combustion engine and electricity, getting to the computer and the internet, and now we are living through another revolution, probably the AI revolution. But beyond those big steps, there's also just the small steps that companies and people are taking every day, and just finding the things they're already doing and doing them in a bit of a smarter way. Maybe a company hasn't been using they haven't been focused on something for a long time, finally get around to it, and now they start using a new tool better, and that kind of like incremental day-to-day innovation can really add up over time. And if a company is improving itself a little bit all the time and another one isn't, that can really make for a big difference between them after a few years. So then from those big drivers that really drive global economic growth long term, we can focus in on what the world economy looks like today. So right now, the overall picture for the global economy is quite fine. Not great, it's not bad, it's just quite fine. GDP growth is positive, okay across the board. Not as good as it could be, but fine. Unemployment rates are looking quite good, but worsening, but good. Interest rates are at a moderate level. They've come down a little bit, but are certainly still far off the negative interest rates that we had before, after the great financial crisis. And it gives room for central banks to address any potential future issues. There's lots of firepower now in central banks again, that if some big negative thing should happen, then they can come in for the rescue. There was a time right after COVID where that was not the case, and I was quite worried then because there we had basically exhausted all firepower. And so if there was another crisis, then we would have been in big trouble. But now, sort of, the firepower reserves are restored, and inflation is still higher than target in America, but much better than during COVID, and not as pressing a concern as it's been in the past. So I think overall this is a decent enough backdrop of economics to be investing in. Then there are some mega trends that I've identified as extra interesting. So if a company is riding on the wave of or driving one or more of these mega trends, then it's more likely to be found in my portfolio. So firstly, I like the nice to haves. When we humans, we have it all, then we like to compete with one another in, who can have the better fashion, who playing fun games, and hopefully we can have a lot more of that in the future. But the nice to haves cannot stand on their own. They can only stand on the shoulders of the need to haves, both in the real world and also in portfolios. If you don't have security as a country, you don't get to decide for yourself. And then all of these other things can fall away. If you don't have energy, you don't get any of these things. Finally, there are the enablers and accelerators that help us do all these things faster, better, cheaper. Most important of these are the companies that are taking us through the AI revolution and stand to make the most profit from that. Those are to be found in the portfolio, along with the companies that will bring us the next generation of amazing devices that we'll all be using in the future. And if you then zoom in on an industry and want to get a quick overview of how things are looking in that industry, you can look at the multiples. So this is an example of the Magnificent Seven, seven of the largest US tech companies. So Microsoft, Apple, Meta, Tesla, Nvidia, Alphabet, and Amazon. And if we look at the top left corner, this is the profit margin. You can see that for Microsoft, they have 46%. That's very nice. Amazon only has 11%. Nvidia 59. If you look at the growth rate, then it's looking good across the board, but not so good for Tesla, whereas Nvidia is looking amazing. These two top charts, the higher the better, because they're about profitability and growth. But the two bottom charts, the lower the better, because they are ultimately about price. So if you look at the bottom left corner, we can see that for every dollar of profit that Microsoft is bringing in, investors have to pay $26. That's quite fine. But for Tesla, we have to pay $287. Now, that's a lot more expensive. Now, granted, whenever a multiple like that goes above 200, it sort of doesn't matter whether it's 200, 500, 10,000, or a trillion. It ultimately means that they're breaking even and they're not, you're not you're not getting much profit for your dollars. And if you have a friend who has $1 and that's all he has, and you have another friend who has $0.0001, like both of them have effectively $0. Both of them are effectively. That's not why you are investing in them. That's not how you're evaluating them. You're not saying that the one that has $1 is like many times richer than the one that has $0.001. They're both effectively equally poor. Then finally at the bottom, we have enterprise value compared to revenue. We can see that we are paying $12 for Microsoft for every dollar of revenue they bring in. Now that's quite fine as well. For Nvidia, we're paying $23, but they're also getting a lot more profit out of every dollar of revenue and growing it a lot faster. For Amazon, we are only paying $4, but they're getting a lot less profitability out of the revenue and also not growing it as fast. So that's a good way to get a quick overview with the multiples. Then I generally follow this approach. I get a lot of data automatically into my models from my data providers, and I also update a lot of numbers that are subjective. This is what I think a number should be, but it's a number, so I can put it together with the other numbers. That could be something like, how much do I like the CEO in this aspect on a scale from 0 to 10? It's subjective, but it's a number and it's useful. Then I do financial modeling, valuing companies, assessing based off of all of that data, what is the value of that company? How does it stack up to other companies as, which one is the best investment, the second best investment, the third best investment, and how do they fit together risk-wise? How can they perform together in different risk scenarios? Then based off of that, I might identify, something I need to look more at. Maybe it's a risk, maybe it's a specific company, maybe it's a specific industry. I need to do more research. So I make a decision to make more research on this area. I have a long list of things that, I don't know enough about and I want to know more. So I research and I learn more. And then as I learn more, maybe I find I need to get different data. Maybe I need to update and, evaluate and get numbers for some different factors. And then that helps me make different valuations, which helps me find other things I need to research or other things I need to worry about. And then that just spins around and around. And with every company that I've analyzed in great detail, I've learned something new. There's always something unique about every company. For instance, when I many years ago analyzed Facebook in great detail, and I didn't just learn that Facebook was an amazing company and that they'd probably be worth a lot one day. I also learned about social media advertising. And then that knowledge about social media advertising, I could then use to evaluate other companies and other factors. And then, so they sort of making each valuations has helped improve my framework, which helped me value other companies better. But in addition to research decisions, I also do investment decisions. So on any given day, there can be, the companies that I've invested in that are the least attractive, they are at risk of being replaced by other investment opportunities. And so sometimes I have to sell something in order to buy something else. And when you add all those up, you get to my portfolio. So today, my portfolio is invested across many different industries, many different countries. My biggest positions are in TSMC and Nvidia. And if we look at my portfolio's composition compared to the US economy, in the US economy, there are many different industries with economic activity and good investment opportunities. I'm relatively more invested in technology, in energy, semiconductor manufacturing, metals, and finance. If we compare to the world, I'm slightly more invested in North America and Europe and less in Asia. Then that was my initial presentation, and now I'll go through the many questions I received. So firstly, this one, many people asked variants of this one and upvoted one of them significantly. Is there an AI bubble? No, I don't think so. I think there are many companies that are doing something with AI where they will get no benefit from it. There are many companies that are doing something with, offering something with AI that are losing money and they will never make any money. So these ones I don't think are good investments. And so there's a lot of money going into certain companies that I think are wasted. And I don't invest in those companies. But I think the companies that are already very profitable and growing very significantly and will have a key position in providing AI services to the world in the long term, I think they're severely undervalued currently. I think the amount of infrastructure we are building is conservative compared to how much there will actually be demand for once AI gets good. And I do think AI will get good. I don't think it's good today, but I think it will get there. And when it gets there, it's going to really enable a lot of services that people will really, really want. And my estimation is that that's going to lead to a lot of profits for certain companies. And yeah, those I love, and those I think are great to have, great to have right now. And I think yeah. What is your strategy on AI investments? So I've crafted many different scenarios what the future could look like under different assumptions, and very important in those is sort of it's not enough that a technology is revolutionary. You also have to make money from it, right? So if there's something that becomes amazing and everybody's using it, but there's too many competitors in the space, then they might compete down the profit. So you have to find the pockets of it where a lot of profit can be captured. So where will be the big markets where you get a lot of profits, and then how are those companies that will get there priced today? And the ones that are not priced fairly compared to their potential for that, those are the ones that I want to have in the portfolio. And I've been following this field a lot longer than most others, basically almost everybody else. I started going deeply into this when in 2017, when I saw OpenAI's very first project, which was an AI for my favorite computer game, Dota. And I was shocked. This was my AI moment in the same way that others earlier had it with when Deep Blue beat Kasparov in chess. And so when GPT-2 came out and 3 came out, I was focusing on this intently, reading patch notes and everything. And when ChatGPT then came out in 2022, I had already spent 5 years deeply in this. And so that sort of gave me an advantage there. And I've just kept building on that since. And that's sort of my basis. I also rely a lot on my brother, I must say, in terms of that. He was in California and did his degree in computer science, and we discussed sort of developments in the field quite a lot. How do you identify potential signs of a shifting market trend toward a bear market? Um, I don't, and it's not really the basis for making great investments to do so. There's a great sort of interview with the former CEO of Goldman Sachs where he says that he can't predict the economy better than the market, and he also knows that nobody else can. So it's not like even if you have access to all the best economists and you're making a better educated guess than others, it's not by a sufficient margin that it's the best category on which to base your investments. So ultimately, when the market has gone up, my portfolio has typically gone up by more, and when the market's gone down, mine's typically gone down by less. So I get the market return plus my skills plus luck, and then you just have to sort of accept that you won't know that now it's switched to a bear market. General terms, the bear markets and bull markets are not so useful. If the market's been going up for 3 months and someone asks you, "Are we in a bull market?" You're like, "Well, it's been going up for the last 3 months, but this very moment, I don't know. It could be going down tomorrow. It could be going down this second." So you can never sort of like categorically define that we are now in a bull market. All you can say is we were in a bull market. You can think we might go into one, but but you're better. It's not about saying like I think this is the most likely thing to happen. Done. Investing is more like saying, right, these multiple things can happen. Let me assign different probabilities to them. Let me ensure that if this thing happen, I only lose this little, and if this thing happen, I do make this much. And by accepting that there are multiple potential outcomes with different probabilities, you can build a portfolio. It's not about just saying what's the most likely outcome. Okay, that's the one I believe in. What do you think about Europe as an investment region? In general, I'm not too excited for Europe as an investment region. I think it's not looking good for most companies. But there are some I think that have great prospects. And so I have large investments in those few ones. And so that gives me an overall high level of European exposure. But it's not from having sort of like Europe overall. It's by having some specific ones out of the many bad ones that I do like. Do you believe in a 4-year market cycle? No, I think this is sort of like, just because you roll a die and there's a 1/6 probability of it landing on a six, it doesn't mean that you're gonna roll a six exactly every 6 years. And there's no specific factors that are like some people are like, oh, the halving cycle drives Bitcoin, this and that. But that's already well known. And the market is not perfectly efficient. It's what you could call efficiently inefficient. If everybody's spending all their time analyzing markets, that's obviously not efficient. And we can't get, the knowledge of every single placement of every photon in the universe to make perfect analysis. So we'd be, having a certain amount of people doing a certain amount of analysis, giving us a little bit of efficiency in markets. And I don't think there's any sort of a 4-year market cycle in there that you can rely on. What's your thoughts on the debasement trade? Do you plan to add precious metals or Bitcoin? So currently, I don't have any direct investments in precious metals or Bitcoin. But if the price of Bitcoin and precious metals is high in the long term, my portfolio will gain a lot from it. I have a Riot platform that owns a lot of Bitcoin and mines more of it, and Coinbase that makes money when people are trading Bitcoin via them. And then I have gold mines that produce a lot of gold and can produce a lot of gold in the long term. So the price of gold stays high in the long term. They can then sell that gold that they will be mining at that higher price. In terms of the debasement trade, um, currencies are prone to lose value as more money is printed. That's a fundamental negative thing about, the major national currencies. And then if that gets really bad at some point, then a lot of people will prefer to use something else like crypto or metals, depending on the exact needs. And that could strongly benefit precious metals and Bitcoin for higher prices for the long term. Um, Debasement comes in many different ways. So if the US dollar loses a lot of value, that also makes other assets when measured in dollars worth more. But there's definitely some people who they want to be safe. They want to be ultra conservative, so they keep all their money in the bank and they have a pension fund that's only invested in bonds, and so they feel super safe. But actually, if there is hyperinflation, which has happened in the past, then suddenly all that money in the bank isn't worth anything, and all of those bonds that pay you money that you get in the bank is also not worth anything. So that's also actually you can put yourself in a what you think is a low risk position, but is actually a very high risk position. Do you plan to diversify away from tech? So in general, I don't, I have a lot of tech investments and, I could sell all of them if I wanted to have something else instead. Every day I plan that every day I'm going to be analyzing the markets. There will not be any like leave for a week, or even on Saturday and Sunday, I'm going to be looking at the markets and and seeing if there's anything important I have to update my views on. And on every given day, I want to have the assets that I on that day think are the most valuable compared to their price that fit together risk-wise. And that could be a different answer than tech at some point. But I don't plan to say like, oh, I don't like my investment in Google now. Let me put in the calendar to sell Google next week. Like, if I don't want to have it, then I sell it now. I don't put it in the calendar to sell it later. So I don't plan to diversify away from tech. Like if I wanted to diversify away from tech, it would have already been done. I wouldn't be sitting here talking about it. I would have already diversified away from tech. So I'm not planning to diversify away from tech then. Do you use stop loss? No. So I do a lot of work to manage risks. And this is one tool you can use to manage risk. But in my view, it's a very bad tool. And there are other better tools. And so I prefer to use the tools that are better. Now, stop loss, you can, you know, put a setting that if the price drops by, say, 25%, you'll automatically sell. Okay, if the stock was to drop 50% and there was liquidity, you would sell it at that minus 25% and you would cut your losses. But what often happens is that a stock drops significantly in price because of a negative event that also causes it to be worth less. Let's say you have a company that owns 10 hotels, but there's a hurricane and one of the hotels is destroyed. Now there's only 9 hotels. You evaluate, well, they were about, it was an average hotel. In my view, the price should be down by 10%, but you see the price is down by 25%. You're like, oh, well, I should buy more on this. I should invest more in this hotel group now because the price is down by 25%, but it's only 10% worse. But then I look in my portfolio and I'm like, oh, but it was minus 25%. So I automatically sold everything. So it's like, but I want to buy more, but I sold. And so here you are basically, one thing is panic selling, which is often not very smart to do. But with stop loss, you're basically programming that you are going to panic sell. And that's just not the right thing to do in my view. So you can manage risk by diversifying and by hedging, and that's the smart way to manage risk. But if there is a certain point where you would want to definitely invest your money differently or invest in something else, you can put a stop loss or conversely a take profit at that level, but it's not tools that I use. How long can we have new highs before we get a correction or dip? So historically, on average, markets have gone up, but it's not a steady rise. The market can double in one year, it can be cut in half in another year, it can go up by 20%, down by 20% in any given month. And that's the rocket ride. That's the volatile nature that you have to accept as an investor to be able to earn long-term high returns. Nobody's giving you very, very safe high return. They're giving you very, very low return. And if you want to, avoid all these highs and lows, then you can just invest in inflation protected bonds and earn a very, very small net interest rate over time so that your money grows from a little bit to a little bit more over many decades. But if you are able to set aside some capital that you can afford to lose and allow that to go up and down and up and down and up and down, but mostly up over a long time, then that's after many decades a much better prospect. Like it can look very risky over a 1 year horizon, but it can look very nice over a 30-year horizon. And because markets on average go up, companies make profits, they reinvest those profits and get bigger over time. Economies expand over time, and there's more and more money printed, so companies become worth more money because there's more money, and so you can basically keep getting new highs forever. It's not like it's not some it's like money is an arbitrary unit of amount, so there's not some upper limit saying like there can maximum ever be, with Bitcoin there is an upper limit. You can't have something ultimately costing more than the total amount of Bitcoins in the world and be well, I guess actually you could. But so there was a great statement by in a talk by Yoni Asia, the CEO of eToro, where he said, if we look to 2030, do I think the markets will overall be up? Yes. But do I think there'll be a correction along the way? Yes. But we don't know when that's going to be. So are you able to buy into that and keep the money in there for 5 years? It's probably a good thing. And then you could say, like, you of course wish that you could time and avoid the dip, and you could time it and avoid the correction, but you can't. You can try to pay a lot of fees and try to attempt it. You'll just be losing money doing it. So you just have to accept that as part of the nature of the game, that there's no uncertain outcomes here, but there are some probabilities for different outcomes. You add them together over time, it adds up in your favor. When do you know it's time to sell? Do you set a price target in advance? So I don't set a price target in advance. I have my valuation of a company, and then there's the price today of that company. And if I can buy a company that I think is very valuable at a low price, then I want to have it. Now, if then things change dramatically, let's say a company stock suddenly costs twice as much, I won't be beholden to whatever number I used to think it had as a value of like, oh, but yeah, but you made 100% on the stock. Shouldn't you sell now and take some profit? Like, it depends on how good this company is today compared to the price today. It doesn't matter what it was like 2 years ago or 5 years ago. I don't care about what the price used to be. I care what the price is now and how valuable I think the company is now. So I think it's very, very stupid to sort of like buy a stock at $50 and then say, I'm going to sell it when it reaches 70. Like, by the time it reaches 70, it's a new company. They might have a new CEO. That product you didn't think was going to succeed succeeded. That technology that was going to work didn't work. It's a new analysis of a new company that you have to make at that day in the future and evaluate if you think it's worth the price at that time. It doesn't matter what the price used to be, and ultimately it doesn't even matter. You're making a new analysis every day on what companies you should have compared to the prices on that day. And yeah, so no sort of old price targets that you wait for to be reached. When do you know it's time to sell? So when I see in my financial models what I should be invested in today, then usually what I should have today is the same that I should have had yesterday. Prices change a little bit, valuation change a little bit, but whenever I see that, wow, I really, based off all of my analysis, like this company a lot more. I want to have more in it. Then I know that it's time to sell whatever I then want to have less of to be able to make that new investment. And my companies are ranked the companies that are the worst investments that I have. They are always at risk of getting replaced by the best investment opportunities I haven't taken yet. And so it's just when they cross certain thresholds, then it's time to sell. It's not like, this particular company is now doing well, so it's time to sell. This company's price has dropped, so it's time to sell. There's nothing like that. It's all just relative to the other ones. If every asset in the world is bad, then I'll just have whichever's least bad. If every company in the world is great, I'll just have whichever are the greatest of the great. And that's when it's time to sell. What do you think about Ray Dalio's book, The Changing World Order? So I really think Ray Dalio, he has been done a great contribution to the world by sharing so many great analysis over the years that have become ingrained in people's way of thinking everywhere. He was one of the early ones to call out the risks of the growing strength of China, and I think that's been very important to a change in the in politics in the world. Um, I think if you have never read any of his books, if you've never seen him talk, it's definitely worthwhile to do. But he does repeat himself quite a lot, so it's sort of he has a few big points, and he always just keeps making those big points. So, like, if I see that Ray Dalio is speaking or the other student on talk, I probably won't watch it now because I'm like, right, I'll think I already know what he's gonna say. But yeah, I met him last year at the Abu Dhabi Finance Week, and he gave me this book. And yeah, I guess he'll be in the Abu Dhabi Finance Week in 10 days, and I'll be there as well. What book would you recommend to learn about tail risk hedging, portfolio management, and scenario analysis? Um, for scenario analysis, I don't know that there is any one particular book that's really great about that. As a management consultant, I've seen many strategy documents with many different scenarios, so that's sort of a framework. In the military, they also do lots of scenario plans, and so you can look at those. Um, in terms of portfolio management, there in university, I think our book was called something like Investments and Portfolio Theory. So whatever book they're using to teach portfolio theory at great universities today, that one would be a great start. Then you can complement that with whichever book they're using to teach statistics. And for tail risk hedging, again, I don't know that there's one particular book, but the one that influenced me the most is definitely one called The Black Swan by Nassim Nicholas Taleb. I read all his books, and that one I read twice, and yeah, that's a really great one. What do you think about Novo Nordisk? Well, this is an absolutely amazing company with great people and great prospects, and both in the current products and future products. So yeah, I definitely like that one a lot. What is your opinion on fusion energy? So I analyzed 8 companies in this space and decided not to invest in any of them. I think the benefits of this technology are far in the future. So there'll be many scientific breakthroughs needed to get there, and maybe there'll be some excitement every time one of those steps in the way is uh, is accomplished, but they won't really break through the ice for a long time. And I think a lot of companies they'll spend a lot of money doing a lot of scientific research that's good for the world, but not necessarily for the shareholders. And if we do have finally, the head breaks through the ice on fusion energy, this changes everything. This is like that would be a massive, massive change for the world, and that would completely change which assets I would have in my portfolio. So if we do see sort of that final breakthrough, or I see that as suddenly being much sooner than previously anticipated, that could cause major changes in my portfolio. And maybe at such a time, I would add something like Helion Energy or one of the other ones. Why did you sell Tesla? I made, I think, 9 or 10,000% on Tesla since I invested in 2016. So it's definitely been an amazing asset for me. When Tesla was founded, I was not interested. I was not interested in electrical vehicles ever. I'm not interested in cars in general. But in 2016, when I learned about their efforts in self-driving, then I became very interested because I'm very interested in AI and the potential future for robotics. So this got me interested in Tesla at the time. And I spoke with the guy at Tesla who was responsible for the early development of the what has become the Optimus robot. And um, I had to listen to so many people trash talk me about Tesla, how clearly this proved that I didn't know anything about investing. And, Tesla is a car company trading like a tech company. And, many people that were supposedly very smart were shorting Tesla at the time and whatnot. But ultimately, I think that turned out very well. Then in terms of selling it, my views on what it takes to win in self-drive and robotics for the future have changed quite a lot. And I don't think that all the value that will come in these technologies goes directly to Tesla. I think even within Elon Musk's wider empire, there are other more interesting companies. And then based off of Tesla's chance at winning each of these important categories and their current price, I don't find it one of the most attractive investments that I could make today. What do you think about AeroVironment compared to other drone stocks? So I really like this one. I think they have the amazing products that are needed right now, and they will have the next generation of products we'll need in the future. Um, they made an amazing strategic acquisition, and that's been really key. And yeah, I really like this one. Why do you not have any UK stocks in the portfolio at the moment? I have had in the past. I'll probably have it in the future as well. I made a lot of money on a Games Workshop. Um, there's probably one company that hypothetically could have been a UK company in my portfolio right now. DeepMind was founded by Demis Hassabis in London. He went to Cambridge University and he founded the company in London, so UK company essentially. And in another timeline, maybe they got listed on the London Stock Exchange, and I invested in the IPO, and they became a very, very big AI company. But in this timeline that we're living in, they got acquired by Google, and so I have DeepMind because I have Google, but I don't have DeepMind as a UK stock because that's just not what happened with them. And in that part, that bit you could blame on the UK, that you say like whatever it is that made it such that a company like DeepMind had to be acquired by an American one instead of becoming its big thing itself. That's sort of, yeah, something to think about. Do you see the rise of retail investors impacting your strategy? So there's sort of two aspects of that question. The sort of easy part is more and more retail investors in the world. That's certainly good for some companies that are, selling products and services for retail investors. So they'll make a lot more money. So that's an impact. Then in terms of retail investors having different preferences from institutional investors. So if everybody had their money via their pension fund, and pension fund managers, they are sort of a certain kind of people doing certain kind of analysis under certain kinds of regulation, then that changes the kind of portfolios that they wish to hold, the kind of risks they wish to take. And then when you have retail investors that have a different risk profile, have a different level of knowledge, have different interests and so forth, and are also using investments for different purposes. Some, more for, building investments over time, and others more to, to have fun and whatever. Then when that initial revolution happened, it had a big effect, and then I think over time now, markets have adjusted to it, and so it doesn't really have much of an impact today. What do you think of aging populations and lower birth rates? These are very serious problems for many countries. With aging populations, you can say that we are also increasing our productivity. We're using more technology. We're becoming smarter as societies. We can produce more with less. So with that, it's not too concerning that there'll be more older people that will need to be cared for, because we should be able to care for more people as well with our improving technology. With the low birth rates, you can't do the same adjustment for it. In fact, I saw one report written by a large consulting firm about aging populations and lower birth rates, and it really, I think, missed the boat with effectively, all of it. It was concerned only on increasing GDP, and all of its suggestions for increasing GDP actually would make birth rates even lower. Like, of course you can increase your GDP in many ways, get younger people to work even more, but then they have less time and effort and would like to have fewer children. And if you take some of the countries that are really doing poorly with birth rates, like China and South Korea, then you could say, okay, maybe they can look to some other countries for inspiration. Is there some countries out there that have had very low declining birth rates and managed to turn it around and get back to good birth rates, or maybe got back to good improving birth rates? And the answer is there's nobody. There's no country out there who's done well. So you don't have any like shining examples. Then you can say, oh, they have high birth rates in Africa. So what can we learn from the Africans on this? And the lessons there are not very nice, not very popular. So they are not some good easy solutions either. Now there are some companies that I've found that I think can make a lot of money from low birth rates. So yeah, those are great to have. But yeah, that's a big challenge for the world. And you read through some reports and you wonder, do they have any good solutions? And like, no. What about this one? No. You hear, "Oh, does that guy have some good ideas?" No. So yeah, ideas are in short supply for solutions in this area, unfortunately. Do you think companies that provide cooling for data centers are good investments? I'd say good investments, yes. Great, no. Um, some time ago, there was a report by a large investment bank who was going big into cooling for data centers, and it was like one of the weakest, most pathetic investment theses I'd ever heard. Is basically they missed the boat on AI. They are not they are analyzing that we'll need a lot of data centers, but they don't really believe in their own analysis. So instead, they say, "Oh, we don't want to invest in these companies that we believe in. We will invest in cooling for AI instead, because then cooling for data centers, because then this sounds like we are, maybe buying shovels in a gold rush, or we are not." If we are wrong on AI, we weren't actually wrong on AI. We were just safely investing in cooling, and so it becomes this sort of like, if you actually have an analysis that says that the base case is we're going to be building a lot of data centers to produce a lot of AI and selling this at high margins, and some companies will make a lot of money from that, then invest in that. Actually have, the courage to invest in that, and don't be like, oh, but I believe that, but I don't really dare to believe what I believe, so I'm going to invest in this lower margin thing instead that, is kind of related but isn't really. Bitcoin to 1 million? Yes. Then the question, a million what? I assume the guy who asked the question means US dollars. That's of course the most used currency. Um, and it's already more than a million in many other currencies like the Iranian real. If you were in Germany before the interwar period, you might think that a barrel of beer could never cost a million Reichsmark. But then there was hyperinflation and suddenly it did. So if currencies collapse, Bitcoin can easily nominally become worth a million US dollars. Now, let's say the US dollar stays intact and we say, can the Bitcoin reach 1 million 2025 US dollars in real terms? So, if the US dollar becomes worth half as much, it would need to then be worth $2 million to succeed at this goal. And there, I also think the answer is yes. I think that if Bitcoin, with some technology around it, gets to the point where it's useful for quick, cheap, easy transactions, then it's going to be super popular. And then I think it can easily be worth a million US dollars in real terms then. What do you think of PayPal as an investment now? Um, they'll face a lot more competition, which I think is a big problem. It's not one that I have in the portfolio. How do dividends work when copying? So Every quarter, JP Morgan, they pay dividends. As investors, we receive those dividends. They remain within your copy. So when I reinvest the dividend, then copiers also reinvest the dividend. And so it just works like that automatically. And you don't have to do anything extra to be sure that the dividends get reinvested. If I choose to receive the dividend and keep it as cash, you also keep yours in cash. If I wait, you wait. And then if I invested, then you copy that investment. And yeah, when you look at the returns in your on your eToro profile, you can see, oh, okay, yeah, I made 30%. That's already including dividends, so you don't have to do any extra calculation to yeah, it's already included in the calculation. Is now a good time to add more funds, or is it better to wait to buy the dip? So I say waiting for the dip is probably the strategy that has lost investors the most money in history. I remember some guy told me he was saving to buy a property, so he's putting some money aside, earning a very poor interest, lower than the inflation rate, and then hoping that this would be enough for a deposit on a property. And I calculated that every year he was actually getting further away from buying that property doing this. So he would enter have to buy a cheaper property. Probably was better off buying a cheaper property then than saving to buy that one because yeah, he's not getting any closer. And yeah, you can potentially do the right timing, probably more with luck than skill, and be lucky that you dodged a correction or you managed to buy the dip. But ultimately, waiting for the markets to go down is a losing proposition. You are more likely to lose than not, and on average, you gain by investing, not by waiting. Um, my portfolio is today invested in the assets that I want to have today. If I thought it was best to have lots of cash today, then I would have lots of cash today. So when you add funds, then you add them and invest them in what I think right now is the best to have right now. If you are making, money every month, you have a bit extra every month, then you can add that at a recurring basis every month, every 3 months, every year, something like that. If you have a lot of cash earning a low interest rate, then you can consider, maybe it would be worthwhile to invest that now, a large chunk of it in the stock market. Um, if in general, it's good for most people to have investments, and then there are some kind of different things with which expenses you have coming up, how long can you deploy the capital for. You don't necessarily want to buy stocks if you need the money in 1 month, because just the initial fees won't make it worthwhile. Then you might be better off just not touching your money for that time. Um, what mindset or strategies do you recommend for staying grounded and making smart decisions? So, in terms of grounded, I'm not sure I'm very grounded, but I say maybe reading lots of books. I usually like to go to bed early, sit in bed next to my girlfriend and read a book. And I think reading books, gives you some knowledge, and sometimes, your mind drifts off and you get a good idea, and you have to read the page again, but maybe that was good. So I think that's a good way to stay calm and collected. In terms of making smart decisions, you can put in different levels of effort to get to a great decision. Um, if you just use your gut feeling, then you get a decision. If you ask some people what they think and you research it a lot, you can get a better decision. If you do that again and again and again, and you come back and you improve upon it, and you really carefully map out what are the important factors and what are all the different options, and you assess them carefully, and you find the right data for it and whatnot, then you can get to make as good a decision as you possibly can in the area, but you also spend a lot of time doing it. So when, for instance, I was a consultant helping a large bank pick a new technology solution, then that's how it would be done. We have lots of people coming in, looking at all the different options, weighing them, and many different things, and doing you know a very serious amount of work to be sure we were making the right decision, because it's $1 billion decision. But if you are wondering whether or not you should pick this beer or this beer, and they're almost the same, you could hypothetically, because they're almost the same, spend forever analyzing it, because which one should you choose? It's so difficult. But here you have to think, will making the right decision, what is the value? What is the value from making the right decision compared to the bad one? If it's not very big, then you don't necessarily want to spend a long time making that analysis. So when two things are almost equally good, you really don't have to analyze them very much. You can just pick the wrong one and you didn't lose much. But then where the difference is very big, where making the right decision is super important, that's where you want to really bring in the whole big framework and spend a long time, spend a lot of research, call in favors to get the knowledge, and really find out how you can make the right decision. So that was my presentation and all the questions. Thank you very much, everybody, for listening, and let's have a great quarter.